Good evening, everyone, and a very warm welcome to today's session. It is my great pleasure to introduce our esteemed speaker, Dr. P.T. Sarvanan. Dr. Sarvanan is a practicing orthopedic surgeon based in Tamil Nadu. His investment journey began during his tenure as a house surgeon. He has been associated with WealthCon since 2020 and has successfully completed WealthCon program. Beyond his own learning journey, he is an active WealthCon speaker. We are truly honored to have him with us today. Please join me in giving a warm welcome to Dr. P.T. Sarvanan. Over to you, sir.
So thank you, A. Madam, for the nice introduction. So it's a small prayer. Let me from the unreal to real, let me from darkness to light, from ignorance to knowledge. So thanks to all the participants for joining us today in this introduction to personal finance. So I am a long-term investor. I have a lot of my own financial mistakes. From that, I have learned a lot. After joining WealthCon, so structurally, I have learned finance and financially doing good. And I am a WealthCon speaker also in many forums, Doctors Forum, and senior guide and preceptor for many of our programs. So Dr. Ramnath Gutte is a founder of WealthCon and mentor to many of us, almost all of us. So those who are associated with WealthCon knows Dr. Ram very well. So those who are new to WealthCon, so he is a founder. He has taught almost 1 lakh doctors this last 7 years. WealthCon started in 2017. The financial profile, MBA Finance, Diploma in Taxation, Certified Research Analyst of NISM, AMFI registered mutual fund distributor. Currently, he is doing MA in Economics. He has over 20 years of experience in trading and finance. So disclaimer, WealthCon is an educational platform. We do not provide investment advice, portfolio management, or recommendation to buy, sell securities. Won't make any performance claims related to financial market. So myself, the speaker, also not a registered SEBI registered investment advisor. We strictly follow the SEBI educational guidelines. Won't give any buy sell recommendation. So no return performance claims. No use of real-time stock price data for education purpose. So SWAN principle in WealthCon, we used to say this SWAN principle. The audience should take whatever is suitable, risk or rest. So be a student to learn maximum. So what we are going to learn today? So to learn systematic way of managing our money, to begin journey of financial education, to become self-reliance in finance, to make decisions, to begin journey of investment and wealth creation and wealth protection. So we won't give investment advice, tips of stocks and mutual fund. We won't give any intraday trading or SATA trading. So to know, get rich quick thing. So what not to do? So never outsource any financial decisions. So we have the financial decision should be our own. So never invest in unregulated and fancy products. So it should be regulated by the market operators. So SEBI to be regulated by SEBI RBI. So never invest in intraday tips trading and stop loss trading, these things. So never expect more than 30% annual return on investment. So in the short term, it's okay. In a long term, persistent return, if anyone tells more than 30% return, he is a gambler. He is telling lie. Never transfer funds to unknown persons. So recently, it's happening for all financial and unwell. So never borrow money to invest in stock market. Never buy consumer loans. So to invest, we have to invest our own money. So never buy ignorance plan. Ignorance plans means investment come insurance plan. That should be avoided. Never invest in MLM schemes like Amway product proposed by our friends and relatives. Never hate wealthy people. So all wealthy people they work hard and they earn money. So never hate them. So never stop learning. So learning is earning is the actually byproduct of learning. Dr. Ramsar used to say. So in financial education, what to learn? So income management, wealth management, and life management. When to learn? It should be from whenever we start earning, at least from today onwards. So why to learn? We should be well self-reliant in finance. Where to learn? So we are fortunate to have a WealthCon. WealthCon is an educational platform for the doctors, by the doctors. WealthCon have a so 6, 7 WealthCon journals. That's a WealthCon website is there. So newly created Nestle research app is there, and we have WhatsApp and Telegram groups for learning and various courses also for doctors. It's only for doctors. So life stages. So it's from a right side slide. It's from the Hinduism. So Dr. Ramsar has simplified this as 3 stages, less than 30. That is from birth to marriage. That's stage 1. That stage have education. After marriage, from marriage to marriage of the last child, that about 30 to 60 years. That period is the earning period, so wealth creating period. After 60 years, after the marriage of last child, that's a retirement period. So that period we need a wealth protection, and also for our personal enjoyment. So in personal finance, so we can divide our things: income, spending, protection. Protection means insurance, loan, investing, and the taxation. These things we are learning today. So how to? So if you are earning 100 rupees, you minimum of 25 rupees, minimum 25 rupees you have to invest for future. So all 100 rupees is going to spend. So present spending is insurance and personal care and other things. And the taxation also present spending. Past spending is so the repayment of loan, EMI and all past spending. Future spending, for that we need an investment. Saving is not enough, we have to invest. So sources of income, active income and passive income. Active income is from our job. So salary or professional income. If it is a self-operated business or self-employed professional, employees get a salary. So passive income, so even without our presence, so money will come. So that from investment we can get a capital gains. Whenever we sell that financial product, we will get a capital gains. Rental income from the house property, interest income from the products, dividend income from shares and shares. So under derivative business also, derivative business is future and option income. So manager operated business, if you are holding a owner of the hospital, even if you without your presence, you will get a money. Then rights and the royalties from your books and other things. So spending, we have to clearly differentiate the product of need and product of prestige. Product of need is day-to-day our life like education, our healthy living expenses. So telephone bills, EB bills, all these bills and needed for food, for residence, accommodation, rent, and everything is a product of need. So avoid this product of prestige to show off to others. The thing is so very costly imported cars, unnecessary jewels beyond certain limit. So like that, and unnecessary gadgets and all. So avoid this social media and party things. So yeah, save as much as money possible. Minimum of 25% to be invested for the future. That's for the future spending. So protection, we need an emergency fund. Emergency fund means should be for next 6 months to 1 year expenses. If COVID-like situation comes, we need an emergency. So we won't have a work income. So we won't work and won't get any income. So that time we need an emergency purpose. So emergency for any even accidents. So like that. So for that emergency fund, we should keep that in a debt products, fixed deposit like that. So emergency fund minimum of 6 months needed. Then another thing is insurance. Insurance is a pure form of protection. So insurance for death. Actually, life insurance is a death insurance. For this health insurance is for disease. So insurance for life. Then disability insurance, critical illness, and liabilities. Since we are medical professional, we have a professional indemnity scheme that also we needed. Insurance is actually an expense. It's not an investment. So illiterate people in finance, they take it as insurance as a tax savings tool and for investment. So investment product is actually in insurance, this ignorance policy. So we used to say it's ignorance policy that the taxation, investment, and also taxation in investment and also so for literate people, insurance is the expense, not a investment, not a investment. So term insurance, health insurance, and indemnity insurance. Indemnity insurance, it's better to take it from a Indian Medical Association. Indian Medical Association have a very good protection. They have lawyers, so they will in Tamil Nadu. I am in Tamil Nadu. In Tamil Nadu, the professional indemnity insurance is there, PPLSs. So almost more than 90% of the cases are settled at the lawyer notice itself. So this is the ignorance plan. Ignorance plan means insurance plus tax saving plus investment together. Investment and insurance should be separate. So in wealth one and in actual financial education, insurance is an expense. So if a person pays 1,20,000 every year for 30 years, in the ignorance plan, they will get only 62 lakhs. At the same time, if they take a pure term insurance and plus invest the rest of the money, 1,20,000, if the return is about 12% as an Nifty return for the past 20 years, they will get a 2,90,000, almost 4.7 times extra. So instead of 62 lakhs, we will get a 2.9 crores. So why this insurance, the ULIP schemes and all have a very less income? Because of the one is commission, so the under the loading. So they will have this life mortality charges will be 100 rupees for a term insurance. At the same time, for ULIP scheme, the mortality charges will be 270 to 350 rupees. So when you are investing, so almost 10 to 20% will go as a commission and also to the mortality charges. So I have checked in the AI, so in the net. So the 2025, the insurance agent's commission comes around 60,000 rupees. Then loan is a past expenses. Dr. Ramsar used to say loan is a modern slavery. Ancient slaves are tied in the chain, but modern slaves they are in the debt trap of the financial institution or banks. The financial institution banks are the master. So EMI should never cross 25% of our monthly income. So EMI should be less than 25%. Then only we won't fall into the debt trap. So literate in finance, they earn first and spend later. They won't take loan. They enjoy now and pay now. They won't take consumer loans or this tourist loan and all. So they earn from credit card. They won't pay to the credit card companies. So in the loan, we used to say good loan and bad loan. So terrorist is always terrorist. Like that, loan is always a loan. So some loans we can take it as a good loan. That one is home loan. We need a shelter. So for that we can take a home loan, business loan to improve our business. Since we are doctor, we can improve our hospital, buy equipments and all. So that will improve our top line. So improve our income. So for that we can take a loan and education purpose. So earning is the byproduct of learning. So for education we can take a loan if we need the money. So whenever you take a loan, this loan should be minimal amount with very lesser duration. Tenure should be very less, and the interest rate also very less, and charges also should be very less, and repay the loan as early as possible. So avoid personal loans, consumer goods, and credit cards. So asset classes. There are 4 asset classes. We can broadly divide into the asset class into 4. G or the Z. One is the gold, real estate, equity, and debt. In the gold, in the physical gold, we can buy gold coins. Jewelry is not an investment product. Jewelry is a pseudo asset. Since it has making charges and so almost 20% charges will go that will erode our investment. So avoid jewelry as investment. So gold coin. So exchange traded fund. That's a advice. That gold piece is very famous in the market. Then sovereign gold bond. Sovereign gold bond from primary market it's not available now. Secondary market still it is available. Real estate, land, residential property, and commercial property. So here the land is the real asset. So building is a pseudo asset. Pseudo asset means it's a depreciating asset. So building won't give any return. So only the land will give the return. So for real estate investment, ideally go for land. So avoid this building and all. Commercial building is okay because that will give a more rent compared to the residential property. Then equity you can directly invest in the shares or the index ETFs, the exchange traded fund or mutual funds, equity mutual funds. Debt product also have ETFs, debt mutual funds and debt ETFs. Then liquid funds, fixed deposit, bank fixed deposit also debt product. Another safe safe debt product is government securities and treasury bills. Treasury bill means the tenure is less than 1 year. Government securities more than 1 year tenure, up to 40 years is that. Regarding bank deposit, one point I want to mention. So bank deposit is guaranteed only up to 5 lakhs. If the bank become bankrupt, the bank won't give more than 5 lakhs. So avoid invest more than 5 lakh in a single bank. You can divide in various banks. Then inflation. Inflation is the silent eroder, silent wealth eroder. So what is inflation? So it's inflation is so every product will be expense will be costlier over the time. That is inflation. So inflation in India is about 6 to 7%. So in 2000, 100 rupee you can buy 10 cups of tea, but today you can't buy more than 3 teas in this 100 rupees. Like that petrol also from 2000 it's 33, now it's 110 rupees. Milk also from 14 rupees to 62 rupees. This is inflation. So one thing Dr. Ram sir has told 1.5 years back. So in 1540, Sri Ashuri, one of the Sultan who has ruled India, he has introduced a 1 rupee coin that is made up of silver. That is 11.6 gram silver. 1 rupee is 11.6 gram silver. Now the 11.6 gram silver around 230 rupees now 1 gram. That 11.6 gram means around 2,500 rupees. So 1 rupee of 1540 is worth 2,000 around 2,500 rupees. That is inflation. So investing is the provision for future spending. Already I told. So for what we are investing is for future spending. So illiterate in finance, they used to do tips-based trading and impulsive trading. They dump the money. But literate in finance, we have to research our own research and invest based on that systematic manner and strategy. So money, we won't dump the money. We invest money with the goals. So regarding the strategies, what to buy. So what to buy means what instruments. So GERD, gold, equity, debt, and real estate. That we are. So real estate also one of the instrument, one of the financial instrument. So why to buy what is the purpose? So for growth or protection. Growth means wealth creation. Protection means protect your money. So it should be at least take care of the inflation. That is wealth protection. So when to buy? The when to buy means entry. Entry ideal thing is SIP and DIP for stocks and mutual fund. SIP means systematic investment plan. Systematic investment plan is not a mutual fund. It's an investment strategy. So systematically you invest. So same amount of money, same date, same product. So every month you invest 10,000 rupees and 10,000 rupees every month in a particular product. So dip means whenever the market down 10% from the recent peak, one additional SIP, additional amount to be invested in the product. So when to sell? So target should be fixed. So target based, if you get a particular value, then you exit that. Otherwise, yes, if you want to hold for 10 years or child marriage like that. So target based investment, that is when to sell, that is a target based. So how much you to buy? So what is the quantity? It should be more than 25% of monthly income. So minimum of 25% to be invested. So you can increase to up to 50%. That's ideal. So how to buy? That is logistic. So where to buy? So physical or online. Nowadays it's everything is online. Broker also online brokers are available. So what are all the investment products? Generic product means individual stocks like Reliance, Bajaj Auto, like that individual stocks. So branded products are mutual funds. Mutual fund is, so one is exchange traded fund of the index or exchange traded fund of so particular sector. Mutual funds, equity mutual fund. So large cap, mid cap, small cap. So then next, so debt products, government bonds, GSEC or T-bill, then fixed deposit of the bank, then public provident fund, Sukanya Samriddhi Yojana, SSY. So same thing in the branded products, so mutual funds, debt mutual funds is there. Then also debt exchange traded funds, liquid funds are there. So gold coin, gold bars, so that's a physical. So in the branded products, the gold exchange traded funds are there. So real estate, land, building and all. So branded products listed in the stock market, real estate investment trust, which is not taken off. In 2019, I think it's a REIT is introduced. So here the issue is there is no compounding effect. So REIT, they'll redistribute the income almost more than 90% they have to distribute with the investor. So there is no compounding effect. So REIT is not taken off in our country. There are 4 ETFs available as of now in the stock market. So avoid fancy high cost commission products which is suitable for illiterate people. So avoid regular plans of mutual funds. Regular plan means through agents. So direct plan means we can directly invest in so there is no commission at all. Regular plans, the agents will get a commission. So the agents will get so initial commission they will get a 0.5 to 3%, depends on the various product. Then also trailing commission. Every investment they will get a 0.3 to 1% commission. So that commission erodes your investment value and also the return. Then avoid insurance plan as an investment, especially ULIP plans and all. So that also the commission will erode, and also investment, the taxation part. And nowadays there won't be tax for the ATC benefit in the new taxation bill. So avoid insurance plans as an investment. Then so newly introduced specified investment fund, alternate investment plan, this are all available in the mutual funds. Then portfolio management service and family office, Ponzi schemes, multi-level marketing, and chits also, and unregulated products, cryptocurrency also. We should avoid these things. So various products, sovereign gold bond. So already told gold bees. That's from it's exchange traded fund. Gold coin, gold future from future and option segment. These things we can invest. Real estate, agri land and non-agri land, residential building, commercial building. So the already mentioned building is not a true asset, building is a pseudo asset. Only the land part is the appreciating asset. Then generic product in the debt is a bank a fixed deposit, government bonds and the private bonds. So government PPF, Sukanya Samriddhi Yojana. So RBI bonds and the treasury bills. Companies also giving private companies also issuing bonds. Then branded product is exchange traded funds, liquid funds, and other debt funds, debt mutual funds. So avoid this ignorance plans, investment company insurance plans or mutual that insurance companies, and avoid pension plans also. So pension plan, only the pension plans suitable for us is say NPS, National Pension Scheme, that we can take. Avoid the insurance company pension plans. So investing in finance, we should know the cost, taxation, liquidity, risk, and return. Return will be the last thing to be asked in the investment. Cost, entry cost, holding cost, and exit cost. Entry cost, even for so everyone knows the real estate. Real estate entry cost, brokerage, and other stamp duty and all. So holding, if you hold even vacant land tax is also there. So we have to pay that for building or maintenance. If it is a building maintenance. Exit also we have to pay brokerage and all. So like that in equity investment also there is a cost of stamp duty, security transaction tax, and brokerage also there for stock brokers. And taxation, short-term capital gains, long-term capital gains, and slab rate. Slab rate debt products are so whatever the duration you hold, so it will be taxed as a slab rate. Long-term capital, whichever product you hold more than 2 years, that will come under long-term capital gains. Long-term capital gain is 12.5% now in the last budget. So short-term capital gain is 20%. So short-term capital gain for equity, it's less. It should be holding period should be less than 1 year. More than 1 year means long-term capital gain. It's especially for the equity. For other real estate and all, 2 years is the holding period. Then liquidity means the volume and the easy of exit. In F&O, ask bid spread. So it should be easily we can liquidate. Real estate is illiquid because it's very difficult to find a buyer if you want to sell. In stocks and mutual funds and all, very easy to exit. Then risk, drawdown risk. If a price goes down, what is the time to take? If it take 1 year to come up to the previous value, that is a drawdown. Then volatility, price fluctuation, then loss of capital. If there is any bankruptcy, there is a risk of loss of capital. Then return, compound annual growth rate, CAGR. That is for the point-to-point return. Then XIRR, extended internal rate of return. That should be for a different, invest in a different period. So in the SIP, we can calculate with the XIRR. Then rolling return, that's an annualized return of a particular period. That's a rolling return we use in the mutual fund. So asset price behavior. So over a long duration, for equity, gold, debt, real estate, everything goes up. If you take a 20 years graph, so everything will go in the long run. But the equity, gold, and real estate, the price will be fluctuating. In a debt product, it is no fluctuation. So since the rate is almost fixed within 6 to 7%, so rate will be graph will be almost straight oblique line. So gold is actually hedge against inflation and also economic answer. Gold is always gold. So last 5 years track record, equity and gold return is almost 120%. Last 5, it's a point-to-point return, almost 120%, and the debt product 38 or 40%. So power of compounding. So Dr. Einstein used to say that compounding is the 8th wonder of the world. So Nifty, if you fix the Nifty return 12%, that's the last 20 years average return. So if a person invests 50,000 rupees every month, the power of compounding works if they hold for a longer, if you invest for a longer duration. If you invest 50,000 every month for 10 years, your investment will double from 60 lakh to 1 lakh, 1 crore 6 lakh. So if you invest the same amount of 50,000 per year for the next 20 years, so your investment amount will be 120, but the estimated value of the 12% will be 4 crore 32 lakhs. That's your investment, not double. It has become 3.6 times in the 20 years. So in 30 years, if you hold this, if you continuously invest for 30 years, same 50,000 per month, so your investment becomes 6.8 times. So here the right side chart, so I'm cursor. So 10 years investment will give 1.6 crores, but it won't give another 1.6 crores in another 10 years. It will give 4.32 crores. So if you hold for another 10 years, hold and continue your investment, it will become 12.31 crores. So start investment today itself, and so invest for a longer duration. You will get a more benefit, more returns. It's a power of compounding. So regarding taxation, Dr. Ram sir used to say death and tax are inevitable. Paying income tax is the highest form of charity. So nowadays we are following only the new taxation regime. So government also phasing out the old regime soon. So new tax regime up to 4 lakh, so no tax. Every 4 lakhs, so 5% increase up to 30%. More than 24 lakhs, 30% fixed rate. This charges, surcharges and all will come after 50 lakhs if your income beyond 50 lakhs. So here, so avoid cash generation. Always show your income and pay tax. So increase your post-tax income. So all your expenses should be pre-tax. So reduce your, so Wealthcon have about 50 type of expenses that we can claim, and you can you can increase your post-tax income. So that tax income you can buy assets. So in cash generation, if it is a black money, you won't buy true assets. You have to buy pseudo assets only. So you can dump your income in investment in real estate. Other things it's not possible. Here in taxation, I like to mention one thing: 44 ADA. we doctors are professionals. Professionals have a presumptive taxation scheme. So you can show that there is no need for auditing, no need to maintain book of records. If your income is 20 lakhs, up to 50%, that is 10. If your income is 20 lakhs, you can show up to 10 lakhs as a expenditure. Then it should be a real expenditure, not a pseudo. So a real expenditure, you can show the rest of the 10 lakh as a your income and pay your tax. No need of auditing, no need of up to 50 lakhs, the 44 ADA for a cash business. If you are 100% generating cash through digital means UPI and all, so you can up to 75 lakhs, this 45 ADA can be applied. So what is best for me? There is no best available. So better and suitable option you can take. So investment means investor plus instrument. So it should be a target. So time horizon. But if your investment time period is more than 7 years, it is long term. So less than that is short term. For long term, you can take equity investment. Short term, equity is not ideal for short term investment. Short term, you can take a debt products. So regarding age, so in younger age, you can take a risk and go for equity investments. Seniors, so reduce your equity and real estate, go for a debt products. So risk appetite and red tolerance. Red tolerance means if your investment, so total investment become negative. So red tolerance, some people tolerate up to 10%, some people tolerate up to, if you tolerate 40% only, your red tolerance will be high. So everything will go if it is a very good product, research product in equity market also. So that is a red tolerance. So you have to take some risk also. So then gold. So wealth creation and wealth protection. Wealth creation is from equity, real estate, and gold. Wealth protection is a debt product that will take care of inflation. So retired peoples, so those who are in the third stage of life, they can take a wealth protection instead of wealth creation. They can also invest, but take care of. You have to take care of your money. You have to protect your money. Then expertise of the investor, minimal or advanced. If it is a minimal investment, go for a passive investment in exchange traded funds, mutual funds, and also stock. Advanced, you can go for a trading, active investment, trading short term trading or long term trading, including future and option also. Then time to track market. So 10 minutes a month, 10 minutes a day. So it makes a difference. If you are not able to spend time, go for a passive investment only. So for active investment, you have to spend time. So take home message, be self-reliant in finance, start learning finance. So take actions. Knowledge without any action is entertainment, Dr. Ramsar used to say. So if you don't have any demat account, open a demat account. So clear your debts. So loan-free life is a great blissful life. Avoid ignorance plans. That's an investment cum insurance plan, including ULIPs or it. So close these policies as early as possible. Then proper tax planning. So and plan for a long-term investment for a wealth creation and also wealth protection if you are above 60 years. So thank you for listening. Please join WealthCon through this WhatsApp number. Call hi, send a hi message in WhatsApp, or you can take this as a screenshot, or just scan this and join our WealthCon broadcast channel. Any questions? You can type and send it in the chat. Karthik, pension plans. So pension plans of the insurance company is better to avoid. So only the National Pension Scheme, NPS is recommended. Avoid this insurance company pension plans. Or about passive investing and importance. So passive investment, every investor should have a passive investment. Passive investment means sip and dip. So usually in the equity, so a sip can be do in the equity, gold, and also debt product. It's not possible in the real estate. So every month you have to invest a particular. If you are able to, your monthly income is 4 lakh, you have to invest a minimum of 1 lakh rupee. That 1 lakh rupee invested in a SIP method, systematic manner, every month, fixed date, fixed amount, instead of no fixed product should be fixed. If you are buying a Nifty index, that's Nifty Bees is one of the brand. If you are investing in a Nifty Bees, you have to invest Nifty Bees every month. It's the same amount, not the quantity, same amount, fixed date. So under dip buying, whenever the market down 10% from the recent peak, that's a dip buying. One more tranche. So large cap is recommended for a passive investment. Large cap means top 100 companies in India. So more than 5,000 companies listed in India. So top 100 companies are so in the exchange traded fund. So there is a Nifty 50 index, that is a top 50 companies. Next 50 index, that is 51 to 100 companies. Then Nifty mid cap index, that's 101 to 250 companies. Then small cap 201 to 500. So that we can cover top 500 companies. So that's a 10% listed companies. That's a cream. So these four we can invest through exchange traded fund or through mutual funds, large cap fund, mid cap fund, and small cap fund. Large cap means top 100. So index means there is a top 100 index means a Nifty 50 and a Nifty index 50. So Nifty's return is about 12 to 14%. As a stock return, 12 to 14% over a long term. So inflation 6 to 7%, GDP also 6 to 7%. If you invest in stock market, you will get a 12 to 14% over a long term. So government keeps inflation and GDP around 6 to 7%. Then you can overcome the inflation. It's like systematic transfer plan. Like a systematic investment plan, there is systematic withdrawal plan, systematic transfer plan. Transfer means from one particular asset to another asset, from debt product to equity product. So if you get a 10 lakh rupee, you can't lump sum invest in equity. So equity to be invested over a period of time. So you can invest that 10 lakh rupee in a debt component, so debt mutual fund. From that systematically you can transfer, so 10% every month. to a equity component. So large cap, mid cap, and small cap. That's a systematic transfer. Systematic withdrawal also for so older people, though those who don't have a regular active income, they can withdraw money from that investment. That's a systematic. Every month is a particular percentage you can fix. So that's a systematic withdrawal plan. All the attendees, those who have not yet joined WealthCon, please join WealthCon WhatsApp channel, Telegram group page, Telegram chat group for discussion. It's given in the chat box. You can click and join in the WealthCon WhatsApp channel or Telegram. Regarding exchange traded funds, so exchange traded fund is actually it's managed by the asset management company, mutual fund company. Exchange traded funds are the name itself exchange traded fund. So it's traded under stock exchange. So we can buy and sell like a stock. So for large cap fund, we can buy a Nifty Bees and the Junior Bees. That's a branded product of Nippon India. So Nifty 50 ETFs are there, Nifty Next 50 ETFs are there, Nifty Mid 150 ETFs are there, and also Nifty Small 250 ETFs also there. We can buy ETFs instead of going for the mutual fund. The exchange traded funds cost is very less compared to mutual fund. So other brands. So exchange traded fund is actually not individual stocks. It's a index based on the index. So the exchange traded fund is actually managed by the asset management company. It's a market makers are there. They will buy if you if you purchase for 1,000 rupees. Not the exchange traded funds is like a stock. It has value. If you purchase 1,000 rupees for Nifty 50, so there are 50 stocks. So that will be purchased by the market maker. That will be added in the added and holded by the asset management company. So whenever you sell, so that will purchased by the another person, or there is no purchaser. You can't sell in the market. It's a market. Only the market maker can do these things. So ETF is actually proxy to the mutual fund in mutual fund, and also it's a very cost effective. You can purchase at any time of the market. So the rate also fluctuate like stock. ETFs available for gold, debt products, and also equity also. Equity index ETFs. Regarding stock selection, so those who are directly invest in stocks instead of ETFs. So WealthCon have created two criteria: MPTDS and MD score criteria. MPTDS means market capitalization should be more than 10,000 crores. So price should be uptrend for the past 5 years. Then the taxation paid should be uptrend for the past 5 years. So taxation is a proxy of profit. So they can't cook up tax. It's a outgo from the company. MPTDS. D is a dividend. Dividend means company is giving back to the shareholder. Dividend should be in uptrend for the past 5 years. S is sales. Sales should be in uptrend. If MPTD is valid, if a company is MPTD is valid, it's a good company. So another criteria is there. It's a MD score. That's a very stringent criteria. So that scoring system. This is available. These things are available. You can type the company and you can check your MPTD score, MPTD validity, MD score in the Nest Life Research website. Nest Life Research. That also WealthCon's website. Nest Life Research. You can go there and check. Lot of information is there. And WealthCon courses are also you can check from the Nest Life Research app. And also from our WealthCon broadcast channel and also the Telegram apps. Admin madam, since there is no more questions, I think can wind up.
Sir, let's wait for 1 more minute. If there will be no questions, we'll wind up, sir. Yeah. Okay, sir, I think there is no more question. So we'll wind up, sir.
Thank you,
Okay?
madam.
Thank you
Good.
so much, sir. Thank you for the session.